Hello there, good evening, and welcome to the pre-show part of our live stream event tonight. Martin Horth here, of course, and the good news is the NBN is back and functioning. We're in pre-show mode at the moment. Those of you who followed me last week will know we got cut. The NBN fell over and we disappeared. I'm sorry for that. The good news is I now have got a backup service if I need it, so hopefully we won't go off again tonight. Hopefully. Anyway, I've got Damien Klassen from Nucleus Wealth with me. We'll get started in just a moment. Just let the tick up a little bit because there'll be a few people, of course, joining in the next 2 or 3 minutes. A lot to get through tonight. Big conversation tonight about interest rates. How low will they go? Is free market capitalism dead? And what about calculating property returns and how to do it? And we'll be able to cover all of those, plus, of course, your own questions as well. So it should be pretty good. Yeah. And yeah, we've got a combination of NBN and also the wireless if necessary. So hopefully we'll be fine tonight. Show us the calculator. Somebody says, no. Yeah, we'll show, maybe later. There's always a chance. I won't be doing postcodes tonight. That's next week. So we've had a few fun and games with postcodes over the last few recent times. Okay, we've got a couple hundred on now. That's very good. And I'll just give another 30 seconds and then we'll get going with the intro and moving on. Of course, the environment has really changed even the last few days, what with Frydenberg's announcement on Thursday and Friday, the budget preparation. They're talking infrastructure investments as well, and manufacturing investments, and I don't know how much of it's smoke and mirrors and how much is real, but we'll see, I guess, in due course. Right. I'm now going to take the pre-show off, and I'm just going to run the credits, and then we'll get going. So stand by. Well, good evening and welcome to this live stream event on the 29th of September 2020. Martin Horth is my name from Digital Finance Analytics. Thank you very much for taking some time out on your Tuesday evening. Great to have you on board. And we've got a very interesting show tonight with Damien Klassen from Nucleus Wealth. He's on standby. He'll be with us in just a moment or two. As normal, though, just a couple of announcements. What I need to say, first of all, of course, is, as I always do, that we're not providing financial advice here tonight. This is just a general conversation. If you need specific financial advice, go find a financial advisor. Also, please play nice in the chat room. The show has been moderated, no racial slurs. And this is the 29th of September 2020. If you're watching this later, you'll know whether we're right or whether we're wrong. As you go forward, if you want to ask a question, use @WalkTheWorld to get my attention. There's always plenty of stuff going on in the chat. I encourage that. But if you want me to see it, then make sure you use @WalkTheWorld, please. And I've also enabled Super Chat, which means that firstly, you can make sure your question goes to the top of the list if you want to ask a question. And also you can make a donation directly to DFA to help us cover the costs of running these shows, which are not insubstantial given the amount we create and given all the stuff we have to do behind the scenes to make it all work. And with that, let's get this show on the road. And the first thing to do is to bring Damien in and turn his sound on. Damien, are you there?
Yeah, hi Martin.
Hello, yeah, it's working. You're good. Phew. Always a sharp intake of breath there when we get going. Thank you very much for spending some time with us this evening. This is a really important conversation. And gee, there's so much going on. I mean, we had a conversation, 2 or 3 months ago, and then we thought it was pretty a roller coaster ride, but it's got even more roller coastery, isn't it?
Yeah, absolutely. Now, we've been speaking a lot about what's this whole suspension of capitalism, and as you alluded to in your introductory statement, there's more and more announcements coming out that just sort of suggesting that's the path we're taking step by step.
Yeah, and I sometimes think we should be talking about free market capitalism, right? Because there's all sorts of other sorts of capitalism. But basically, my read of the situation is that basically nothing can be allowed to fail. Everything is being propped up. But there are some implications on that, aren't there? In terms of, well, if you actually start having businesses that are weak, and they extend credit to other businesses or stock to other businesses, and they basically get weak, so the contagion can grow unless you actually can control it. And that's the thing I'm worried about, the web of connectivity.
Yeah, absolutely. And that whole idea that you can have, you only need one or two bad actors who decide that they're going to keep flipping between got to run up their debts to one supplier, and then they just pull that and go to the next supplier, and then the next supplier, and next thing you know, some of these suppliers start to fall over. The good guys fall over because they're looking at it going, I can't afford to pay my debts. I have to pull a pin for the sake of my my staff and the people I owe money to. Whereas some of the bad actors who can just keep going to the next one, to the next one, to the next one, and by the time they do blow up, it's no longer like a small loss. It's turned into a big loss that threatens to pull down lots of other companies with it.
My other observation is there's been a lot of focus on supporting big companies, airlines and those sorts of things, but a lot of smaller businesses probably needed more support sooner, and I don't know whether there'll be stuff in the budget around that, but it seems to me that the SME sector is really under the gun at the moment. 1/3, according to my surveys, may not be here in 6 months' time. They just don't have the ability to continue. So that's a big concern.
Yeah, and I mean, in the first round we had $40 billion, promised to small and medium businesses, and I think it was at 1.7 we're up to billion got lent in total. So you didn't even make sort of 5% of what was promised.
No, and it's very interesting talking to SMEs that they just they couldn't see the point, right? It was just too hard, despite what the banks said. Anyway, look, you've got a bit of a presentation, and I think perhaps we should move on to that, Damien. Because I think it's really good to get a context for the discussion and the conversations. So what I'm going to do is I'm going to hand the screen across to you, and I'll let you run with that. And just to say to people that what we'll be doing is letting Damien take us through this first, and then we'll be asking questions later. So if you've got specific questions, hold off at the moment and ask them a bit later. Over to you.
Yeah, thanks, Martin. So there's two things I wanted to run through. Was first is this idea of this eye of the storm that we've spoken a little bit about before in the past, and secondly is something I sort of just put out today, looking at the possibilities of 0.5% mortgage rates in Australia, and and what that means for the property market and the economy in general. And so so I'll kick off with the eye of the storm first. Oh, sorry, and then the last thing was to have a quick look at that property calculator, which I'd alluded to as well. So we spoke about these bankruptcies, and so far in the US, which hasn't actually put as many restrictions on companies going bankrupt as what we've seen elsewhere, like in places like Australia, bankruptcies are down about 30% over the year, and so they have put some benefits on it. So there's two ways to look at this. It's either like, hey, isn't this a great year? Nobody's going bankrupt, or wow, in the biggest downturn we've had since the Great Depression, we don't even know how many companies are going bankrupt, and it's not like those bankruptcies have gone away. That's just the usual rate. Like we're down 30% plus on the usual rate of bankruptcies, and so just those ones coming back plus all these other ones is what's going to cause the issues. And so that's in the US. You see the same thing within Australia. You look at the UK, you look at Europe, and you're just seeing that same thing over and over again. And the first, to me, that first sort of 3 or 4 months, I could see some justification. If you genuinely had a view that there was a possibility that everything might bounce back. There was a good reason to say let's put some of these bankruptcies on hold for 2 or 3 months and let it wash through the system. Now we're 6 months in, and it's been kicked another 6 months down the path by a lot of governments around the world. It starts to talk about saying, well, do we think that a system where nobody is ever allowed to go bankrupt it will be perfectly fine, or do we think we're actually just putting a band-aid on what might actually be a wound that's going to start getting infected and eventually need amputation. So the idea of this whole thing is with bankruptcies is you're generally better off taking your medicine much earlier, and not only shareholders but debt holders and employees and everyone are much better off facing up to facts much earlier than they are if they wait. And it's this thought about some of these jobs are just never coming back. So if you take something in the tourism industry, for example, and you said, we needed 1,000 jobs in a particular scope, and now we haven't got the tourists anymore. Now we only need 500 jobs. Well, do we keep employing 1,000 people in the hope that sector might come back, even if it takes 2, 3, 4 years? Or do we actually let those people move off and go to different jobs and actually get them employed doing something else? And then if the sector picks up in 2, 3, 4 years' time, they can always hire people back in. And so, that's this two competing macroeconomic effects. You don't want that first part. You don't want the bankruptcies to start this huge snowball and bring the whole economy down. But the flip side is you don't want the lack of it to mean that it's festering. And in my view, we've passed the point of sensible delays, and we're well into the part of creating more problems down the track as this goes on. So, the question you step back for politicians then is, it's the same, and for anyone is, do you want to take a little bit of short-term pain for a large amount of economic gain later on, or do you want to take a little short-term gain for a large amount of economic pain later on? And the more sensible people would say, well, yeah, let's just take the short-term pain, but that's certainly not what we're seeing from politicians pretty much anywhere since the financial crisis. Is if we can kick it down the road, then it's done. It's kicked down the road until later. Then the next step is this whole valuation, is saying, okay, well, once we've done that and we've put all these things on suspension, how much do we think we should be paying for companies when we don't really know what's going on underneath the surface? And I've got a chart up here showing, so this is the US forward price to earnings ratios. It's basically at highs. The only other time it's been higher is during the tech boom. So we've got these sort of record valuations, but the rejoinder to that from most is saying, oh, well, yeah, but that's because these are just depressed earnings. Earnings are going to bounce back as soon as there's a cure for the virus or next year or whatever rolls out, and then everything will be fine. And if said, okay, well, I've got this red line on the chart is saying, well, if you took 2019 earnings and assumed that that's where you could get back to, then you're still trading at price to earnings ratios that are above anything we've seen, any time except for the tech boom. And so it's that idea that yes, things will eventually recover. There's a lot of these companies are going to do very well out of it. There's some tech companies in particular that are beneficiaries, but there's a price for everything. And right now, with heightened uncertainty, do you really think that paying max top dollar for stocks is your best option? And in my view, no, it's not. That's where we're taking our sort of superannuation clients or our investors and sort of moving them into other assets where we think they can still make returns without anywhere near the risk that you can that they're getting in the equities market at the moment. So that's the eye of the storm part. The next part is this idea of these mortgage rates, and so. Prior to COVID, maybe about 9-12 months ago, we set about making a mortgage a house price calculator that we wanted to put up online, so that people could go in there and play around with some of the economic assumptions and actually look at what it means for house prices. And the real reason for me doing this was that I wanted to be able to show to people that property was sort of in this purgatory period, I'm calling it, where basically it's so dependent upon interest rates that if you saw the economy improve and interest rates started to tick up, well, that basically puts a lid on property prices. And the flip side is, if the economy got worse, then that factored into to job losses, and then that sort of meant that property prices were going down. So you sort of had this idea that you had some downside for property, but you really didn't have much upside. And so one of the things I did within that calculator was look at just sort of interest rates and say, well, we've got a few different scenarios. So we do a bad case, a good case, a property paradise case, and we let you go in and play around with the assumptions once we've done it. So the idea is we'll preset a few things for you and then let you go in and play with the assumptions. And the big mistake I made was that we looked at standard variable rates, and we said, well, given where standard variable rates are and interest rates, let's just cap. We'll make it so that you can't make interest rates go any lower than 2%, which at the time sounded like a real stretch. But we're obviously there already, just about. The Australian government's basically, or sorry, not the Australian government, the RBA has put in a process and a mechanism to actually give us even lower interest rates. So there's a bit of talk about, will the RBA cut or won't it cut at the next meeting? To me, that's a bit meaningless now. Like, it doesn't, like what they're doing with their interest rates will affect the Australian dollar. So there's something in that, but the real game right now is what's called the TFF. And term funding facility. And basically what it is it's a way where the RBA right now is lending to banks at 0.25%. So for 3-year loans, as long as that's loans are going out to small businesses or to mortgages. So they started this TFF, and they initially it was limited to 3% of lending, 3% of I think total lending they'd done, 3% of their total book. Then they added in some extra ones. So that was the initial plan. Then they had an additional plan where basically if you'd lent a bit to businesses, you could actually top that up and lend out even more. And now they've added in a supplementary plan. So you're well over 5% now that the banks can lend. And it looks like it's here to stay. Nobody really seems to pay much attention to what's going on, but that's the real core in terms of what's going to drive interest rates in the Australian market right now. Is that TFF is what's letting banks bring their 3-year fixed rates down well below what their variable rates are. And so within that, you sort of go, well, what's happening elsewhere? I mean, Japan, Germany, France, they've all already got 0.5% mortgage rates. There's a bunch of acronyms that have been flying around Europe for years, where the European Central Bank has basically led the way, and the Australian central banks basically following what happened in Europe. So in Europe in 2014, they did a similar thing where they started at 10 basis points, so 0.1% was how much the central bank would loan to European banks, as long as those European banks went and lent it out as a mortgage. Then they lowered it in 2016 to negative 0.4%, and earlier this year they lowered it again to negative 1%. So to keep that in perspective, Martin, if you went out and got a loan, if you're in Germany and you go to Deutsche Bank and you get yourself a home loan, and you're paying 0.5%, say, in interest, what that means is the bank's effectively funding that is you're paying the bank 0.5%. For it, and then the European Central Bank is paying the bank another 1% just to try and get you out there to lend the money. So the banks are already being paid to lend. There wasn't a lot of uproar in Europe about it because mostly they use quite long terms and it's quite arcane banker speak, and so I guess it just passes through. Some would say, oh, isn't that a great idea for banks? There's all this free money coming into all these banks. It's actually a terrible idea because what happens is banks basically make money from what's called a steep yield curve. So they want to lend out money at a long term and borrow money at a shorter term. So basically, when the curve's quite steep, when they can lend out for high prices and borrow for lower prices, they make lots of money. And it doesn't really matter whether interest rates are 5% or 10% or 0%. As long as they've got that steep yield curve, they make the money. And the problem is, though, because all these central banks are pushing interest rates down as far as they can, is we haven't got a flat yield curve. And so what that's meant for the banks is, European banks are down 54% in the last 5 years versus the world market up 50% in the same time period. So might sound like it's a good idea for banks, but the forerunner and why we've been quite negative on the banks for some time is because this is where we think the Australian market's going. Is that if you're not getting an improved economy and you're just going to try and shove more debt into it, it means the debt's going to have to be lower and lower priced, and that's going to flatten the yield curve, and that's going to cramp all the banks' profits, and effectively you end up with they're almost state owned. You'd have to say if you're pumping out and paying 2/3 of the interest is coming from the central bank and only a third of the interest is being paid by the actual person taking out the loan, then it's pretty close to being a state-owned bank. Australia's got other problems though, because we're sitting here we've already got twice as much debt as all these European countries. So you sort of go, well, all these European countries with all these low loans, there must be all this debt. But the reality is, they've sort of got household debt to GDPs of 50 and 60%, versus we're already at sort of 120. So we've already got a roaring fire going, and we'd like to pour a bit more gasoline on the fire just to get a little bit higher. So it's not a direct analogy. We look at the sort of the last few years as sort of saying, we had this boom in 2012 to 2017, where basically every factor we could think of was headed in the right direction. Credit availability, the price of credit, employment, population growth, foreign buyers, tax incentives. We've got lots of money laundering going on still, restrictive planning, and an undersupply. So we basically had everything you needed for that boom. Into the bust, and really all that happened was the credit got pulled back and everything else sort of stayed the same. Before COVID, we were sort of in a similar position. That credit availability eased up again, so that sort of got prices starting to tick a little bit higher again. And now we've hit this COVID, and we've got this price of credit and credit availability have gone boom in one direction. Employment and population growth have gone boom in the opposite direction. And so it's really leaving us in this point where I'm calling it a battle royale there. We've got two massive forces meeting each other and saying, well, if that's the case, which way does the property market go under those conditions? Probably the closest analogy I have is what happened in Perth. So from 2014 to 2018, you basically had exactly the same financial conditions in Perth, all this easy credit and lots of lending going on, the same factors that we saw in the eastern states. But the flip side was they had a falling, increasing unemployment rate. And what we saw there was that property prices couldn't stand up to that. So when the immovable object meets the irresistible force, in this case, it was the property, it was the unemployment that won out, and the property prices went down. Now, not to say that's going to happen every time, but I think that's my base case, is that if it sort of matters who gets in first. So if we cut rates to 0.5% now, for example, I think it probably could spark a bit of a housing boom and push things along, and maybe that'd mean a few of these people who can't pay their mortgages would be able to get out of their mortgages without taking a huge bath on it, or maybe a little bit of a profit, and you might be able to, that things might go on. You're setting up your economy for lots and lots of trouble, but it probably means that property prices will go higher. If you wait too late, though, to lower the rates, so if you get this snowball effect and the bankruptcies start and the forced sales start and all these, the stuff you talk about all the time, Martin, with the mortgage stress actually turns into mortgage sales, and you let that get out of control, well, it doesn't really matter how much credit you want to pump into the economy. Once it's free falling, nobody wants to borrow, and so you have to wait till it sort of hit the bottom and then pick up the pieces. So I guess what I'm looking at is this real idea of this binary outcome where it's almost as if who gets in first. And so we saw that last week that Frydenberg coming out with his wants banks to lend irresponsibly. We have the RBA already trying to get cheap loans out there, and with the mechanisms get much cheaper loans. And so now it's just a race against the bankruptcies and the mortgage stress that you're seeing, Martin, and how soon that starts to really affect the market at the ground level. So that's that part. I might flick quickly to this calculator if we've got enough time, Martin. Is it?
Yes, just carry on. Yes, let's do that.
Keep going. Yep. Okay, so I've got this calculator, and hopefully you can see that, Martin, coming up on the screen.
All good. Yep, carry on.
Good. Yep. So the idea is, it's what I'm really trying to show here is that there's a couple of levers you can pull, and by pulling one lever, like you can't sort of go out there and make one assumption about, say, price to sales of a company, of a property, or an assumption about what the mortgage rate is going to do versus the rental rate, and not have that effect flow onto other things. So the idea is I've got 4 different ways you can forecast these properties. I'll start with a house. So you choose your unit or your house. If you click on estate, you'll see the rents start to change. We just sort of default it to whatever the going rate is for estate. So let's say we're looking at New South Wales, $1 million with $200,000 down, just to make the numbers nice and easy, and we've got a rent of almost $30,000 on that. You've got a few different economic scenarios. So if you mouse over them, we'll show you what, this one's sort of saying 1.5% inflation, what the wage growth, rental growth, and things like that are. But we'll let you play with those later. So we'll just assume you pick the low growth for now. Now what we're trying to do, we've got 4 different ways to forecast. One is by saying the mortgage cost to rent. So what we're saying here is that we think when mortgage costs go down, then people start looking at what the cost of it is to rent versus what the cost it is to buy, and so more people will end up buying. And vice versa, when the mortgage cost to rent goes up, then you see the opposite happen. So this is the Sydney house market, which is the most expensive in the Australia, but you can basically see that when it gets below 100, it seems to be about when it bottoms out, and when it gets to 200, that's when it tops out. So basically, when people are looking at their rent, saying, "Okay, I'm paying $1,000 a week in rent, and it's going to cost me $2,000 a week to buy a house," well, they tend to stop. When they're looking at their rent and saying it's costing me $1,000 a week in rent, and the mortgage is going to cost me $1,000 a week as well, it seems like that's where the Sydney housing market seems to bottom out. And so you can pick a level. At the moment, we're about 150, so we're basically dead in the middle. You can move that slider up and down and change what happens if you like. You can do a similar thing with mortgage cost of wages. So same argument, but saying, okay, this time what we're saying is people need to be able to afford what they're buying. So if it's going to take more than 50% of their wages in Sydney, more than 50% of the average wage, then it starts to get it seems to cap out, especially more like around about the sort of 60 or 70%, and then when it falls down to sort of 30% is when it seems to rise. We have a property price to wages as well. This one I don't think is as important. You get some much bigger jumps in these numbers, and it does affect people who are saving for the deposit. But I think this one's a bit of a lesser effect, but it is worth having it there. And then finally, rental yield, so more for the investors about what type of returns investors want. But I think, Martin, you'll certainly agree that the time for investors to try and make money from a yield is far gone. It's all about the capital growth. There's this, it's so let's use the mortgage cost to rent as the example. So that's basically saying, based on this one, with interest rates going down, we've got our property going up in value. I do a comparison if you're using debt or no debt. And we can jump in and play around with some of these assumptions. I think I've actually, I think what's happened with this is I'd preset this assumption. Sorry, let me, I was playing around with this beforehand. So sorry, that's with a 2.5%, with a 2.5% interest rate rather than a 0.5. And you can see it's basically going, look, the property takes a big jump downwards to start. Now, a lot of that's you're getting in costs, so your entry costs. And then it gradually works its way back over 10 years so that you're almost even. If you didn't buy it if you bought it without debt, and assuming you could find a property for $200,000, then you'd lose a lot less at the start, and you'd be in front by the end of it, but not massively in front. And this sort of shows the breakup of how much you invested, the entry costs versus the rent you're receiving, property costs, interests, and things like that. But then you can go and say, well, what happens if interest rates do fall to 0.5%? Well, let's pick 1% as anyway. We won't go right in feet first at the moment. And you say, okay, what does that do? That sort of means that the property is actually going to increase in value over that time frame, given those factors. And you can look at some of these other ones and say, well, what do I think average wages are going to do? Because that will then affect, if I want to look at some of these other ratios about what does that mean for property price to full-time wages? Well, it's going to all-time highs. It's going to go 15 times. The mortgage payment to your wage is going to fall because of interest rates are falling down to sort of 50-odd%, which is roughly its 10-year average. And so under those conditions, you can sort of look at what's happening with the property prices and sort of make some assessments as to how positive or negative you need to be about inflation or other factors. So I guess the net effect from it though is if you put interest rates down with all else being equal, then property prices are going to go up. But it is a factor of, are you getting the wage growth? Are you getting the unemployment? There's a number of these other factors that can smash it. But over the longer term, those will wash out. If we've got if in 10 years' time we've still got 0.5% interest rates, then property prices are going to be a hell of a lot higher than what they are today. So
Excellent.
hopefully that's a bit of a summary, and we can jump in and take some questions.
Yeah, great. Okay, well, thank you for that, and I'll let you switch back to your main screen. Yeah, this calculator, I think, is the best in the business that I've seen, right? Because it's a little complicated initially, but if you take it step by step, you can get a really, really good view of the very elements that actually lead to returns or not in property. And it's quite scary when you put all the numbers in, right? A lot of entry costs, which people often forget, right? Absolutely. Some of the cost of carry related stuff is also there. And if you're a property investor and if you're not very careful, you can end up with negative returns. You're basically banking on capital growth, right? And then, as you said earlier on, well, that is they're predicated on two countervailing forces. The first force is low interest rates, right? The second is higher unemployment and therefore more inability to make those mortgage repayments, right? And those two forces are pulling in opposite directions at the moment. I monitor the mortgage stress stuff, as you know, and I'm seeing very high levels of stress in some areas across the country, even with JobKeeper and JobSeeker. And
actually, what I'm interested, so Perth, let's say Perth, so lockdown for, they've been probably the best of the states. Yep. How much rental stress are you seeing there versus other states?
Well, the answer is that it's changing quite quickly because their rents are starting to go up. And as a result of that, more people are finding it harder to be able to pay those rents. Plus, of course, tourism is still very heavily hit over there. Yep. Retail is looking very weak as well. And so whilst the mining sector is looking not too bad, there are other pockets where it's pretty uncomfortable. And if you come out of Perth and go down the coast to Mandurah, which is I keep talking about Mandurah because it's the one that I keep coming back to, right, as the leading example, because I saw the mortgage stress there a few years ago, sent the Four Corners team across to it and said, look, watch this postcode because this is where you're going to see all this playing out. If you go back today, prices are down 38%, 1 in 5 households are in negative equity, more trying to sell. So, you can see pockets, but the point again with this is you have to go granular, right? Because if you take averages across the whole of the Western Australia or whole of Perth, you miss all of these nuances, right?
Yeah, and actually that's really interesting what you're saying though as well, because the other part is that we've had this huge wave of stimulus hit everyone, and so all this money is coming into the country, into the economy, but it's not even. And you've got some people have lost their job, and it's like, okay, that's taken me down to 50% of what I've used to have. And there's other people like our Solomon Lews and people like that who are out there saying, well, look, record profits, times have never been better. And I sort of feel as if some of that's what's affecting the stock market, and potentially what's helping to hold the housing market up is that the winners are sitting there going, I've got all this money I can't spend. And so I'll put it in the stock market, or I'll put it in the housing market or whatever. But that works while they're getting this extra money, and also while we're not seeing the bankruptcies and we're not seeing people get kicked out of the house for not paying the rent and those types of factors. So, yeah.
No, well, you're absolutely right on that. And look, the issue is that there is huge diversity here. There are some people who actually started paying down mortgages. So what's interesting is if you look at the breakdown of the mortgages, there's a lot of refinancing going on, including some equity extraction, but there's also a lot of paying down of mortgages. So people are paying it down because they're uncomfortable about how much debt they've got. So that's something which is being a bit masked by everything else.
Rightfully so.
Quite right? Yes. But there are also others who are saying, oh, whoopee, I've got this money from the government. And if you do a quick, in back of an envelope, right, 19 billion was the amount out of super, right?
Yes.
19 billion. 7 billion was JobKeeper. 7 billion was JobSeeker, roughly the numbers. About 2 to 3 billion was the interest and principal repayment holidays, right?
Yep.
And if you put all of that there's been a huge increase in liquidity into the system, and that's why the broad money is very high at the moment, right?
Yes.
But that got to more than 20% of GDP. That was last quarter. Now this quarter it's 7.5%. Next quarter it's 2%. So you've got this cliff, right? And I look at your thoughts around very low interest rates in the context of that cliff.
Yes,
right?
Exactly.
And it's the question of how those two things interact, and it goes then to your main question, which is, so who is it going to hit, right? And then I come to my other point about 1/3 of small businesses are saying, I may not be around in 6 months because I can't continue to trade through this, right? And some of those small businesses are funding their business based on a mortgage that they hold on their primary property, right?
Absolutely.
So my theory is that this is going to unwind from small businesses out, right? And that we'll find that the property market will sort of drift down in some of those areas. That will sort of be offset by some people who will be attracted by the first home owner grants and will pile in.
Yep.
And
0.5% interest rates.
0.5% interest rates. But look, there's an interesting chart which I will share with you because I think it's quite interesting, right? And it's this one here. This is the CBA housing demand supply chart, right? Which basically said, look, if you look at this current supply of property and the current demand of property, for the first time, we've got way more property than demand for property, right? That's a really interesting chart because what that says is that unless something fundamentally changes in terms of supply and demand, we're going to be in difficulty in terms of propping up property prices, right? And then the other one, which is quite interesting, is this. This is the net migration, right? So this is showing that migration's down through the floor. In fact, even Frydenberg in his speech the other day said this year and next year, we're going to see net negative migration to Australia. In other words, the population's going down. And bearing in mind how much the population is being supported by migration. So you put those two factors in the mix as well, and there is another set of reasons why it may well be that the the equilibrium is down rather than up. That's why this is such a fascinating, complex thing to try and model.
Yeah, absolutely. And it's interesting to put in context as well, because I had that question on Twitter today from somebody about saying, oh, well, Perth, Perth, the prices fell over that 2014 to 2018 because population growth fell off. And it's like, well, it didn't really fall off. It was running at 1.1%. Like it was lower than what it was in prior years. But to put that in perspective, that's about double what the US grew at over the same period. So it's not like Perth was shrinking while we had those property prices falling. As I said, I think my default is definitely down. But the thing is, if I said, well, if they came out, if the RBA on Tuesday said, you know what, we think things are going to get really bad, everyone can have a 0.5% mortgage just like they have in Europe, I think there'd be a rush for the entrance, and there'd be jam-packed full of investors, and away we'd go. And a bit like everything was spent, as you said, we've thrown all this stimulus at the problem before the problem's really hit, and then by the time the problem's hitting, it's like, oh, well, actually, we're going to need some more.
Well, no, there is certainly that scenario which plays out. In fact, I've updated my scenarios now to include that sort of. And next week, I'm going to go through that in more detail with all the data that comes to the end of September, because you're absolutely right. You could see very low rates following through, and of course there's the Peter Tulip model, which he's now left the Reserve Bank, but he basically showed that the most critical thing is interest rates, house prices, almost direct correlation. But the other question, of course, is risk. Right? What's the level of risk in that, right? And you can actually write loans with very low interest rates, but if people can lose their jobs and can't then make those repayments, it's actually irrelevant what the interest rate is.
Absolutely, and that's exactly what happened with the small business lending. So the government was taking half the risk, but the banks just went, I don't want to lend it. Why would I want to lend to small businesses in the middle of the biggest economic downturn we've seen since the Great Depression? Yeah. So they didn't. Yeah.
And so whilst the ASIC thing is being taken away probably by March next year, the APRA rules about risk portfolio management of the mortgage books are there and are much stronger than they were, right? So that could actually temper the bank's appetite to do all the lending that people think they might do.
We hope. We have to hope.
Maybe, fingers crossed.
Yes. Yeah, so because I think we're both in agreement is that there's a big difference between what should be done and what will be done.
We're talking political, right? So the political agenda is get to the next election without house prices falling too far.
Exactly.
Right. Yes. That's the clear political agenda, right? We'll do anything and everything to stop those prices falling, right?
Yes.
Even if that means that the 200% debt to income ratio goes to 220, 230, as you say, we'll win all the prizes, right? Rather than just most of the prizes for more debt. And it's also just remembering, because the other point I always come back to is if you think about, all the people in households, only 1/3 are borrowing, right? 1/3 have no debt and own their own property, and 1/3 are in rentals, right? So we've got this concentration of debt in 1/3 of the population. And within there, we know about 40% of them are actually already struggling with cash flow, right?
Yep.
So you come back then to the question of the marginal borrower and the marginal buyer and how that plays into this too, right? Because you don't need them all to fall over. You only need a relatively small proportion to fall over to create forced sales and then to create more pressures more broadly in the economy. And that's the other thing that I think I come back to, which is that we know that a lot of those people without mortgages have been reliant on income from term deposits and things like that. Well, that's gone. I mean, there's no income from term deposits, right? So they're under some pressure. And of course, renters are also under pressure too. So there is a broader set of pressures on the economy than just the housing and market element.
Absolutely.
And yet everybody fixates on mortgages, mortgage repayments and interest mortgage rates.
Yeah. And you'd only take, let's say a third of the people who aren't paying their mortgages at the moment can't actually, genuinely can't keep paying their mortgages. That'd decimate that whole housing market. So especially on top of all those the falls, as you said, in immigration, which I've been racking my brain. I haven't heard a good scenario. We know that the government wants to bring in more people. I just haven't heard a likely scenario where they would be able to. Because from my mind, where Australia really did well in the financial crisis, in terms of adding more people in the depths of that whole crisis, and if you want to call it well, is that we had lots of jobs here. So when people were saying, I've lost my job in London, okay, I'll come back to Australia because there's a mining boom going on, or I've lost my job somewhere else, or I'll move I'll move across. Whereas I think if you're in in another country now and you don't have a support network in Australia already, would you pick up your family and move it with the view that you might get locked down and lose your job? And what are you going to do? Whereas at least you're like, well, I'm in my own country. If I get locked down and lose my job, I've got friends or I've got relatives or I've got some sort of support network. And so, from my mind, I just can't see that immigration coming back anytime soon. But I'm interested in seeing people who have a different view. So.
Yeah, well, there are some, but I spoke to somebody very senior in the airline industry the other day who said 2 years. Expect it to be 2 years before travel is pretty much unblocked from most countries around the world. 2 years, right? And that's a scary thought. Now, I'm just looking at some of the questions here. Cookie Boy asked a question to both of us. I'll let you answer first. Could we see interest rates go up? And what would be the trigger?
Well, under my scenario, never again. We're already talking about. I mean,
it's a one-way trip, isn't it?
Yeah, and the issue is the more debt we add, the less you can ever put it back up again. We're going to have to start moving interest rates. When they do, they'll start talking. They won't be talking about 25 basis points. They'll be talking we're going to put up interest rates by 3 basis points this month, and then wait and see how much unemployment that causes before they'll move on. So, no, look, I think, I can't think of any reason why. Well, actually, sorry, no, the biggest reason is modern monetary theory is or the like. If you saw a concerted effort to spend as much money as possible, then you could see interest rates rising again. Beyond that, I struggle to think of a reason why we could.
Yeah, I tend to agree. I mean, there was quite a lot of publicity the other day from an article that was suggesting that rates could move up faster. But, the Reserve Bank said it's going to be at least 3 years, right? And they're controlling the yield curve through that mechanism that you discussed earlier on. People haven't got their head around that yet to understand precisely what they are doing. This is more about controlling the rate, right, out along the yield curve, and then dictating essentially the real rate. And of course, the other thing that's happening, which is something that's also is worth focusing on, is that the funding that the Reserve Bank is funneling into the banks at these very low rates is replacing bonds that previously were written overseas.
Yes,
right?
Absolutely.
And this is something which people haven't got their head around, because it's not necessarily expanding the bank's balance sheets. What it is doing is replacing one set of funding with another set of funding, right? It's at a lower rate, but that's the other thing that people need to understand. And the point there is that the banks can choose what they invest that money in, right? So are they going to make more loans? Or are they going to actually go and speculate in derivatives, for example? I
I think there's some restrictions. I don't know, but the banks are known for how they can get around those types of restrictions.
Well, that money over there I'll use for lending, but the other money that's now freed up I can use for
exactly
derivatives. And look, if you look at Europe, it was very interesting that the review of low rates in Europe said 4 things. The first one was there is a limit to how low you can take deposit rates, because basically people just don't put money into the system at a certain level. Secondly, that as rates come down, banks find it more and more difficult to lend because they just can't make the economics work, which means that thirdly, they then go and speculate more in high speculative areas like trading and derivatives and those sorts of things, right? And then the fourth one is overall profitability of the banks is absolutely squeezed. So basically it's desperation stakes for the banks in terms of trying to manage their business and squeezing costs out and squeezing jobs out and all of those things. Those are the 4 scenarios that people should be thinking about, because that's where we are.
Yeah, absolutely. And we've seen what's great for Australia is we've seen where everyone else has gone with it. We're just following one step by step down the path.
Yeah, we're just late.
Yeah,
later.
While we're on the interest rates, the other one that was fascinating, I still have to look a bit more into this, but the New Zealand market basically, like the 5-year bond rate is negative there.
Yeah.
And so the short-term rates are positive, the 5-year rate's negative, and the long-term rates get back to positive again. And in a way, to me, that what the market's basically saying is, as soon as the RBA, as soon as the New Zealand central bank said, yes, we will take rates negative if they need to, the market went, well, you haven't worked it out yet, but you're going to need to, and it's going to be within the next 5 years. And so they've immediately priced it in. And I guess that's the question for the Australian one is we've said no, we won't need negative rates, but.
Yet.
We'll probably be there.
Have you noticed that every time the Reserve Bank denies negative rates, the strength of the denial is getting weaker and weaker and weaker and weaker, right? Phil Lowe, end of last year, said, no, it's not really even on the agenda. And then he said, well, maybe. And then DeBell said, well, it's something we're not really thinking about very actively. And I don't know whether you saw this, but in there was a paper released under the bulletin that was actually talking about cryptocurrencies. Right, and central bank digital currencies, and there was a little note there that said, some analysts believe that actually negative interest rates and digital currencies can assist in executing monetary policy, right? And I'm thinking, well, that's interesting. A little sort of slide there that nobody really quite noticed, right? So I wonder how much they're really seriously thinking about it.
Well, see, I hadn't seen that in the Australian one, but I've seen a lot of the overseas ones, the discussions of that. And that seems, I don't know, I guess for me, the issue with those is it starts to get, how do I take money away from people? Like I can't have negative interest rates, and now let me start taking money away from people who aren't spending, and that doesn't seem like a popular move for me. It doesn't seem like the way to get voted back in. Whereas modern monetary theory about, hey, we can't generate inflation, we may as well just print some more money and give it to people. That seems like that'll be popular amongst voters. Whereas
I think going back to our politics, right? The politics of it is throw money at people because that means they can spend stuff and they'll feel better about us, and that means they'll vote us back in again, right? This is a political agenda. It's not an economic agenda, and that's the thing we need to understand, because there is really very little long-term coherence to the economic strategy. I mean, if we wanted to actually rebuild the economy, we should be investing in productive assets and productive businesses to create more growth for the future, not just powering up house prices even more, right?
Yeah, absolutely. And we've spoken a lot about, in the intro, you spoke a little bit about some of the manufacturing and some of the infrastructure. I struggle to see what they're actually doing. Like it seems to be a rehash. There seem to be re-announcements of stuff that's been
re-announcements. Come on, they never do that, do they?
But it's like, we've got $100 billion worth of infrastructure. And you're like, oh, fantastic. What are they going to build? And it's like, well, all the stuff we've already announced. Yeah, it's like $100 billion, over the next 10 years. And you're like, but what about the new stuff?
I have to say that they're a master of re-announcing the things they've re-announced previously to re-announce them again, right? And when you actually stand back and think about it, okay, well, that was interesting. And then actually look back later, and it's like the bushfire relief packages, right, which were announced. How many of those have been spent? Not a lot. Yeah. So that's the other point to make a note of. Now, Otto's got an interesting one. The issue, as I see it, he says, is the banks will be creating more bad debts to go with the bad debts already in the system that have not been allowed to crystallise. Now, what's your perspective with regard to APRA's handling of, these loans are not bad loans, and bad debts aren't an issue, and et cetera, et cetera?
Look over there. Yeah.
Yes.
Look, I mean, I'll tell you what the end game is. I think for this is that you lend as much as you can, you get your interest rates down as low as you can. You have a bunch of bad debts. You either nationalise some of your banks, or you just package up all the bad ones, stick them into a bad bank, and then off you go again. I think that's the end game. And so, what pretenses are given along that path as to why you're doing that? That I can't guess. But I think that's where, to me, that's where we're going. Is that most crises you need to get rid of the debt at some stage, and that seems to be the easiest way to do it.
Well, it's interesting because people like Steve Keen says there's too much debt. Ultimately, you've got to find a way of diffusing the debt, right? Be it a debt jubilee or whatever it is, because we've got to the point now where the debt is such a large proportion, even with low interest rates, right? The thing that I come back to is debt fundamentally has to be repaid. The capital has to be repaid, not just servicing the debt, right? And I know that banks can say, well, okay, as long as you go on paying, interest only, you just pay enough to sort of service the debt, and that allows us then to keep it on the book as a good loan. And of course, those long, thin slithers of repayments over many years are a cash flow that they can then monetize. But at the end of the day, there's debt that is stuck and has to be repaid at some point.
Yeah, and it's not good for the people who have the debt though either.
No,
the thing is, like, everyone sort of talks about saying, the banks and all this stuff like that, and it's best for these people. But realistically, for somebody who's in a position where they were probably bankrupt 6 months ago, the last 6 months have probably been terrible for them. Like every day waking up and going, oh God, I've got to try and get this. And okay, fingers crossed, I hope we don't go back into lockdown or whatever's going to happen. Maybe I can get it back to 80% of what I used to make. And then I'm like break even. I'm not getting any further behind or things like that. It would have been far more humane to pull a pin on them, 3 or 4 months ago and say, there you go. You know what? You are bankrupt. It's really sad. It is traumatic, but that is very cathartic. Now you've got a blank slate. You've actually got a position you can actually get out of this versus actually saying to that same person, you know what, have another 6 months of wondering whether you're going to be able to afford it, and are you going to lose your house and all these other things. So,
well, it's very interesting. Free market capitalism is built around the idea that sometimes there will be destruction as well as creation, right? And that's actually quite cathartic, and actually means the capital goes to the more value creating activities rather than just supporting everything, right? And of course, around the world, we've got zombie companies all over the place. I think we've got zombie households as well who've got massive amounts of debt and basically are just struggling just to keep everything, roughly on track, using things like buy now, pay later to be able to sort of try and manage the cash flow and all of those things. That's not conducive to household confidence, which you need to be able to actually get to go out and spend more, because they've got no money to spend in the first place, and secondly, they don't feel like it. So that whole issue of confidence, right, is, I think, the critical issue.
Or to start new businesses. Like, am I better off having all this capital tied up as a bank? All this capital tied up in these dying businesses that you're trying to, if I can just scrape this, I can get some more money and they can make their interest payment this one, or dropped it, gone, that was into a bad bank or wherever it is that's been pushed aside and written off. And now I can actually worry about, okay, where am I actually going to get some growth from? Where's this new business idea that will actually make us money?
Yeah, no, that's spot on. And it's worth just recalling, in the US, after the global financial crisis, we saw prices start to sort of move down. But the peak of the fall was actually 4 years after the global financial crisis, right? And the peak of defaults was also about 4 years, right? And it's the same in the Ireland and same in the UK. So this is another, I think, important point to understand, that this is not something that's going to sort of magically turn itself around, right? Even with all of these low interest rates and everything else, we're going to see this grind down with high unemployment for a long period of time, more business failures, more mortgage defaults. And, that is going to take, half a decade to really turn around and come back the other way. So we're actually looking, I think, as potentially a lost decade compared with where perhaps we were going. And
well, and that gets back to the RBA, doesn't it? So you're expecting you're not expecting inflation then to be at 2%.
I'm not expecting inflation to be around. And look, there's a big. Well, let's have the debate now. Inflation or deflation, right? Because it's probably one of the biggest debates around, right? Do we think that the future is inflation? All this money creation and all this liquidity that's going into the system, right? Many people believe that that's going to stoke inflation significantly, and basically we're going to see asset prices continue to go ever higher, and therefore the best strategy is to hold gold, because at least gold gives you some certainty. I mean, that's one school of thought, right? And there are many people who thinks that inflation is the real risk that we face, and they quote the 1970s, right? Another school of thought says, actually, this is more like Japan, this is more like Europe, where they've been at this longer, printing more and more stuff, throwing more and more liquidity in, and getting no inflation at all. And in fact, assets are being devalued. And, you showed the European stock price of banks as a good leading indicator of the problems there. And these two worlds are pulling in completely different directions, right? It's fascinating because from an asset allocation perspective, you would do different things, wouldn't you, in an inflation or deflation environment?
Yeah, absolutely. Look, my takes is on deflation. Look, I think you do need inflation at some stage to get out of this. I think there is a certain logic that goes, the only sensible way to get out of this is for massive amounts of spending and to generate inflation that will actually get people's wages and wage inflation. When I say inflation, wage inflation is the important part. Actually get wages going so that somebody who's taken out debt today, in 10 years' time, their wages have gone up, and so the debt's no longer as big, and you've inflated away the problem. But I can't see that happening yet. So I think that there's the logical steps to say the only way out of this is that we do get this big burst of inflation is right, but we're seeing no signs of that happening. And until we actually see signs of it happening, you just have to assume the current orthodoxy, which is we just keep banging our head against the wall and hoping we get a different solution.
Well, I actually spoke to George Gammon, who's a guy over in the US that I speak with from time to time, and he made the point that he doesn't think that the central bank's current strategies will ever lead to inflation. Right?
No.
They've actually got to break the mold and basically think of a different set of strategies if they really want to bring inflation back. And he basically said, well, what's the evidence to suggest that following Japan and following the Eurozone, which is what we're doing, is actually taking us somewhere different?
Yeah, and I guess I'd argue, look, we came off the gold standard in the 70s, and at the time we had this huge oil boom, which really drove prices, which really pushed prices right throughout economies in this upwards. And so there's a question about how much of that inflation was genuine, too much expansion, and how much of it was trying to allocate scarce resources across an economy. And then I'd argue that we've basically set up this financial system that has this negative drift inbuilt into it, in terms of saying, there's a big slap on the hand for anyone who prints any money, with the view that it'll be Weimar Germany or Zimbabwe or whatever it is coming up on you, if you print $1 of debt. And so we've got this negative drift, and where inflation just keeps getting lower and lower and lower, and there's no real way to get it positive. Like basically the central banks know how to get people to go out and borrow more money to stop inflation from falling, but they don't know how to get inflation rising again.
No.
And so you need to be able to basically give it back to government. So we're waiting for people to be voted in, who are running on these policies of modern monetary theory, and it's going to take time. It'll take time and pain, and you need to see some more unemployment and things aren't working, and before people will be prepared to vote for.
And look, the point is people don't want to take any pain, of course, and politicians don't want to inflict pain, and nobody wants to see home prices fall. So you can understand why they are trying to sort of go back to the pre-COVID environment and just replay the script from there. Unfortunately, the older definition of insanity is you do the same thing again and again and expect a different outcome. Well, I suspect that's a bit where we are.
Yeah, and we joke, sort of joke about, that's the Liberal Party's plan is to do what Howard did, which is, you sort of restrict your government spending, you let the RBA do its work, and then you wait for China to have a boom, and then everything's fine. And
except that the China relationship this time around is looking a bit more wobbly, right?
It is. Yeah. And China's, the big issue in China really for me is that they're spending they've got all this production supply side that they've really put all their money into. And so the problem there is, if you just say we're going to fund all these factories and get all these factories pumping out more and more goods, then those goods have to go somewhere. And if your local population, the demand's very weak, and they're not out there buying all this stuff, then it has to go offshore, which means it has to come to Australia and to the UK and to the US and all these other countries. And that's why, and they're not particularly happy because we turn around and give somebody $1,000 and they take that $1,000 and go and as a job keeper, and they take that and go and spend it on Chinese goods. And so there's no Australians who've been employed in that. So we want it to be, we want the $1,000 to go back into the Australian economy to employ people, to get more people working and get the whole thing going again. So I mean, that's just going to create more and more problems going forward. So more political issues.
No, it is, and it just shows you how complicated this whole thing is. Now, interesting, Greg asked this question: bonds, cash, precious metals, low yields, are they actually still safe in this scenario? Interesting question.
Well, precious metals don't have any yields, so but that looks good when yields get low. So I guess the issue we have with, we're relatively positive on gold. Not because we think it's a magical asset and it's got all these great features, but we think that we're going to go through environments where lots of other people are going to want gold. As you said, like there's that, you spoke about the whole theory that gets behind, in the gold's sort of the ultimate greater fool. If I think other people are going to buy it, then it's a good thing to buy. And we treat it as a currency in terms of, and we do think everyone's going to be trying to devalue their own currencies by printing as much money as they can, and so therefore, we can see the upside in gold for that. Bonds, we think the Aussie bonds have still got further to go. So we've got lots of bonds at the moment, where the Australian bond yields are close to 1% for the 10-year bonds. Most of the rest of the world is close to zero. So we saw as soon as New Zealand suggested that they might have negative interest rates at some time, the 5-year bond went negative in New Zealand, and it's a very similar economy to Australia. Very similar. We've got all the same banks there, so we look upon that as there's still some scope in bonds, and then what was the other question? Sorry, was equities? Was there equities
precious metal bonds? I think were the main ones.
And the final bit with equities is just saying, well, do I want to get a 3% yield on an equities where I might lose money? Like it's very different saying I'll take a bond where, especially a government bond where I know I'm getting my money back. Maybe there's inflation issues, but if the Australian government can print, I'm getting the money back. So versus saying, well, I'll take a 3% yield on Australian shares with the thing that I might lose 20%. If in the wrong scenarios,
this is what I keep saying to people. There's no such thing as a free ride when it comes to investments, right? There's every investment asset class has a different risk profile potentially, but there's no such thing as a free lunch, is there?
No, and there's an argument. I get the argument all the time from people about saying, well, look, equities generally go up, like the nets, over the course of history. If you buy equities, you make profits over them over the long term, and it's absolutely right. But you can go through sort of 10-year periods where you don't make money on them, and most people don't like going 6 months without making money. So going 10 years without making money is
But of course, property doubles every 7 years, right?
That's right. It's a
half the people in my survey still believe that. Scary.
That's an excellent marketing job. It's an excellent marketing job.
It's superb.
Came up with that. Yeah.
Exactly. Yeah. Okay. And now, Bank of Queensland today came out with a high provision, right? A much higher provision than many people thought. And I guess my question to you is, what do you think about the level of provisioning that the banks are currently making for post-COVID environment, bearing in mind all the things we've been discussing?
I don't think it's anywhere near enough. Look, but I mean, the fact that you can have such large proportions of your book not paying any interest at all, just having a holiday and not have to provide it and make the assumption that it'll all come back, is concerning for people who thought that accounting, this is what accounting was for, was to make sure we knew how big these problems were. But I guess it's really, it shows though. And there's probably some justification in it, in terms of trying to hold the whole economic system together. Is if you all around sudden turned around and said, "Oh wow, all our banks are insolvent," bad luck, guys, you're going to have to withdraw your money, or we'll start dishing out whatever's left. And that's obviously going to create much larger problems. And that I think what APRA's trying to do is saying, well, let's try and delay things as much as possible, and then we'll flip some assets here, and we'll get the RBA to fund the banks very cheaply to help get their profits back up. But it comes back to what I was saying in Europe, which is you're effectively nationalising your banking system, and so it's a question of how much money you want to. How the banks are almost dependent upon how much free money the central bank's going to give them, and so you hope they don't give them too much. But maybe the Australian government decides they do want to give. They do want not only do they want to give cheap money, but they want our banks to have record profits as well. So.
Well, it makes a very interesting question, right? Because there is a point at which you say, hang on a moment, to what extent should we be continuing to feed all of our taxpayer money into the banks, right, to support the banking system? Why not give it direct to end consumers, right? Helicopter money or whatever you want to call it, or MMT, right? Is that a more effective way of trying to sort of stimulate and support the economy? I mean,
are you trying to tell me that letting somebody buy their fifth investment property is not as effective as maybe the government going out and building more bridges and roads and stuff like that?
Well, heavens offend. Yeah, no, exactly right. I mean, you know that I believe that property is way overvalued, and you know that I believe that this has been a policy setting for at least 30 years, right? And it's been deliberate, right?
Yes.
So to my mind, there's nothing happenstances about this at all. This is a deliberate policy, government after government, from Treasury through the Reserve Bank, etc., all the regulators, right? And it hasn't served us well, right? Because we've invested more and more money into property and less money into productive assets and into small businesses and other things that we should have been investing in. And so our economy has narrowed and narrowed and narrowed to the point where, well, you've got the holes, the mining sector, and you've got the homes, and that's about it.
Yeah. Well, and you look at all these businesses that are struggling, and you say, well, if all of them could pay half the rent, if property prices were half the price and rents were half the price, then a lot of them would find it a lot easier to be able to manage and keep going. But it's there's one I spoke about. I might have spoken about on your program last time, but there's this idea of the factors of production, where you say you've got your say you're looking at a restaurant. You've got your employees working at it. You've got the owner who's taking the entrepreneurial risk. You've got the landlord who owns the property, and then you've got the bank that's supplying the capital. And you say, okay, this thing's run into trouble. You've had a COVID hit, and there's trouble there. Who should take the pain? And you go, well, if you want the economy to keep going, you let the landlord take as much pain as possible, because that landlord, if goes broke, you replace it with a new landlord, and everything's still the same, And the next one then is the bank. You let the bank take the capital, the people putting capital in. But the problem is, if you let the entrepreneur go broke, well, now you've lost that, and you've got to wait everyone's stuffed, because now, the bank's not getting its money because it's not getting paid. The landlord's not getting his money, and the employee's unemployed. If you let all the employees go, then they're not eating at other restaurants, or they're not eating at shopping at. And so, but we've turned around and said, well, let's make sure the banks are all right. Let's make sure our landlords are all right. And let's let the burden go back on the your entrepreneurs and your people. And that's if you want a nice, the best possible, the least possible pain for the whole economy, you do it the other way around.
Yeah. Well, I tend to agree with you. And interesting, I talk to quite a few entrepreneurs who are struggling. That they've got the ideas, they've got the business plan. They go to the bank, and the bank says, "Nah." Shameful.
No, the bank says, how much equity have you got in your property?
That's true. Yes.
Exactly. We don't care about your business plan. Put that to the side. Show me your property. Show me how much equity you got in your property.
Correct. Yeah. Now, Cookie Boy's asked an interesting question. 3.6 million people just had their property keeper payments cut. It's good pun there, Cookie Boy. Will we see a rise in defaults and mortgage sales off the back of that? What's your sense on that?
Oh, okay. Actually, I'll let you go first. You're the expert on housing stress, and then I'll tell you what I think.
Well, okay. So my perspective is this: that we are seeing quite a few people who were in mortgage stress, even with JobKeeper and JobSeeker, right, now having those payments withdrawn. So the cash flow equilibrium is being disturbed quite worryingly. Now the question is, how many of those are now getting back to real jobs, and can the hours worked replace effectively the JobKeeper, JobSeeker payments that they had? At the moment, I'm not seeing much evidence of that happening yet. Now, maybe it will with the unlocking of Victoria and et cetera, but I wonder whether the damage has already been done too much, and whether effectively that cash flow that came in, many people on JobKeeper still took a pay cut, right? They didn't get what they were getting previously, because a lot of the people who were on JobKeeper were actually more paid more. JobSeeker, maybe not so much. My worry is that we will see some of those fall over. And of course, the banks are actually starting to put quite a lot of pressure on some of those people who have had interest and principal repayment holidays, because now they want to get them to start. But if they can't actually do it because their income has fundamentally shifted and won't come back, well, that's when they start talking about, well, maybe you should think about selling your property. We don't want to foreclose on you, but, it might be good for you. And, if you sell sooner rather than later, I mean, that's the sort of conversation now that I'm getting reported quite a lot coming through.
Yeah, and that's this whole, on the banks, it's the classic prisoner's dilemma. If you're the first one in to getting all your problem customers out of their properties, then you can probably sell the properties at close to current prices and you're off and running. But everyone else, now it's everyone else's problem. But if everyone else does the same thing all at the same time, you all crash the property market, and now you all lose lots of money. And so, look, I guess my issues that I'm trying to weigh up on the whole JobKeeper cuts is, do I think people would default on their loans? I think the banks, they're extending as much as they can, and so eventually, but I don't think it's happening straight away. I think you're right that there's going to be this conversation of you need to start selling. Hopefully we'll get a few more sales of properties for people who, rather than this extend and pretend. I do think people, if given the chance, and the bankruptcy stats show that pretty much globally, people if given the chance won't go bankrupt. They will hold on and hope that something will come along. And so I think eventually, but I think we're still in this period of holding on and hoping, and our governments seem to be dedicated to letting that happen. I mean, we've seen a few. I think now on the eviction stuff, I think we're down to the New South Wales government is still saying that they're going to evict people. I think mid-October.
They haven't extended it, but most
exactly.
Have.
That's very everyone else has extended it.
Correct.
They're the only ones saying they're going to, and so how many years do you think people shouldn't be able to pay their rent for before they say, well, maybe you should find somewhere else?
All right. And look, my point about this whole issue is, if you think about it from somebody who's not paying their rent, right? That was because they're not working in the cafe that they're working in previously, right? But that rent that was being paid was actually paying the property investor's mortgage, right? Who now suddenly can't pay that property mortgage, right? So all these sort of long chains of connections, right? And my worry is that we don't often think about the long chains, right? So that retail store that person was working in previously, or that cafe, was owned by a small business who now is not able to pay their rent, right? And on it goes. And it's these long chains of connections, right? It's like a game of consequences, right? The first domino falls over and they all follow, right?
Yeah,
and it's a question of where do you try and stop the thing falling over? That's the really interesting question.
And your property investor's like, well, I haven't been paying my mortgage, but I'm owed $10,000 by this tenant, and you're like, you're not getting money from that tenant, and especially not $10,000 in any time soon. Maybe you'll end up with some sort of, okay, he's paying you $50 a week for the next 20 years, but there's not, you're not getting those big amounts back from people.
And interesting, a lot of it in my surveys, a lot of renters are not clear whether those the rental holidays have been just a deferral or whether they've been forgiven.
Right.
Which is sort of a pretty basic question, isn't it? Am I still going to be owed that 6 months of rent at the end, or is it gone forever, right?
Yeah. And I guess it's that the word holiday is sounds inviting, doesn't it?
Yes.
You're
sunshine, sea, what could possibly go wrong?
Whereas I think from a lot of the people who own the properties are probably going, well, a holiday means you get to not pay for a little bit, but you're still paying at the end.
No, indeed. Now, a couple of people are asking about Chris Joy's property market views, which are still relatively bullish. And of course, Westpac came out recently and said, well, we could see 15% property price rises, in a couple of years. And it's interesting, we're seeing a bit of bifurcation in terms of, Fitch came out and said, well, no, prices are going to fall perhaps 10%. NAB's still down rather than up. I mean, Can anybody predict, do you think, what's going on, or are there too many variables to make any sense of it?
Yeah, look, I think there's too many variables. I mean, I guess what I'm thinking is, I think Chris could be right if the thing for me for Chris to be right was what we were talking about before, is they decide, right, we're going to throw everything at this housing market right now, and we're going to lower interest rates even further. We're going to pump as much debt as possible in there. We're going to try and get as many people out of these houses that have them, flip them onto investors and things like that. You could get this short-term pop, but it's a short-term pop, and that's it. That's you've only got so many bullets left. We've been firing our bullets for years, trying to hold the property price where it is.
Yeah.
We've sort of got this chance to say, oh, well, we can lower interest rates a lot further. And you're saying, well, you want to do it now just to prop the housing price up for a few more months? Like, really? Don't you want to try and use that to wouldn't it be better to let some semblance of reality come into it and then use that to help repair the market once it is damaged? But it's a
political question, though.
Yeah, that's right. So if you're betting on, so in my mind, what Chris is basically, for Chris to be right, it needs to be a political decision that we're going to throw everything at it right now, and we're not going to hold anything back for later, which I think would be a bad decision, but it might happen. I think it's much more likely that that there's some negative drift, and you just can't. There's just too many. There's too many of these bankruptcies, and actually the one I was going to say as well is from one of the previous questions, which flows into this, is I think most larger companies and even mid-sized companies, they don't need everyone who's working with them, but you hire people, and it is hard to fire people. Like, and you're sitting there going, well, yeah, they're doing a bit of work, and I'm still making profit. I'll keep them on. These things happen. And you go, and those people get fired because it's like, well, now I'm in trouble. I've just cut my profits, my sales have been cut by 20%. That person I don't need. That person I don't need. They don't get hired back. And productivity of new software and all these other factors keep on going on. These productivity gains get up court, and those people, when it all covers, they have to find a new job and possibly even in a new industry. So. That part just doesn't bounce back easily, and I think that's lost in some of these.
Well, I talk about structural unemployment, right? So initially, the first wave of unemployment were part-time, casual, jobs that come and go. But we're seeing a lot of middle managers in large firms suddenly being, asked to leave, right? It's sort of compressed the the management tiers, and a lot of those, of course, are on very big incomes. A lot of those are multiple property investors as well as a big mortgage. They are suddenly finding, in some cases, that they are now getting it to the point where they cannot find another job, right? And that is where I'm seeing a very significant dent in terms of rises of mortgage stress and difficulty, right? Because these people are just not used to living hand to mouth and living with cash flow pressures and living with which do I pay? Do I pay the mortgage or do I eat? Those sorts of. But some of those are having to face those decisions. This is a really structural issue, and I think we're only just started to see the start of it now.
And that's all that the RBA research and Treasury research from the last time is basically why they say go hard, go early, is because if somebody's mid-50s and they lose their job, especially in middle management, they may never get another job. A lot of them won't, and almost definitely, and a large proportion of the ones that do get jobs will be at much lower salaries than what they were before.
I think that's right. Well, they'll have to go and start their own YouTube channel.
That's right.
Simple job. Now, another interesting question. When you think about your portfolio of investment, do you think about geographic risk much in terms of across Australia or even other countries?
Absolutely. So, look, where we see Australia sitting is well down on the scale of where we'd like to be invested. So even a lot of the companies which we are buying in Australia are companies which have international exposure and aren't as exposed to such an indebted economy. So when you go through these downturns, the way to think about the Australian, or the way most people look at the Australian economy, is it's a supercharged economy. It's very reliant on resources, and resources goes well when the world economy is going well. Resources go well, and when the world economies go badly, the resources tend to go very badly. And so the world's obviously not going very well, and so that sort of flows on to going, okay, there's a flow-on effect of, less people hired in mining companies and less revenue coming through for the government in mining royalties, and so that all flows down the line. And so so that's one part. The second part is when you have these big economic shocks, you don't want to be the people who have lots of debt. The first thing we did in sort of January, February, as we were seeing the coronavirus hitting and when we need to clear out things out of our portfolio, was just went, right, anyone who has, look, we don't tend to buy overgeared companies anyway, but anyone who even has a modicum of too much debt is just out the door straight away. And so you don't want to be in countries where the population's got lots of debt. And so Australia sort of ticks all the wrong boxes in that perspective. And so ideally, I think the best thing for Australia is a lower Australian dollar. That's what we really need to recover. To actually, the best thing to recover our manufacturing sector would be for the Aussie dollar to be in the 50 cents sort of range. And I don't think it'll get there because I don't think I don't think it's going to get there soon because the RBA hasn't got the same view as they sort of figure if we just keep doing what we've been doing, everything will be fine. And so does the government. And so, so we're sort of very much where we can get away from Australian investments, we're getting away from Australian investments. Government bonds is different. So we're happy to own those in Australia. And then internationally, look, it's a bit mixed at the moment. Europe's obviously doing a lot worse, but it's interesting that you can often buy companies in Europe that they're multinationals that have operations right around the world, and because they happen to be listed in Europe, often they're a lot cheaper than what that same company would cost if it happened to be listed in the US. And so we spend a lot of time looking at where companies actually really do their business, because that's where we think the genuine economic benefits will come from, and we can find stocks that are just way cheaper in some of these peripheral markets.
Shows you just how complicated the whole thing is. And I was going to ask about the Aussie dollar because, of course, as you say, the Reserve Bank seems to be relatively relaxed at sort of 70. But of course, at that you're almost importing in deflation rather than inflation, right?
Yeah.
Which is a bit tricky, and it puts more pressure on our firms here.
Yeah, everyone's been playing the currency devaluation game, except for Australia, really, over the last few years. The US is really, the US sort of starting to get to the swing of it, printing as much as they can. Japan's been playing it for 10, 15 years. Europe's trying to do it as well. Australia's sort of tended to not really want to try and get the Australian dollar down, and I think there's I think we'll have higher unemployment because of it. So I think eventually we'll get there, but I think it would be less taxing for the population if we could get the Australian dollar down faster.
Yeah, it's interesting. Now, there's a couple of other questions just come in. One which is from DIY, says, I'm going to reiterate what Mike Martins, I did a show with Mike Martins from the calendar the other day. Do you think there's enough foreign investing in property through SPVs for property drops to be insignificant? So there's basically this idea that people are still investing from overseas into property in Australia. Interesting theory. I'm not sure I subscribe to it particularly strongly.
Well, yeah, I honestly don't know right now what's happening with foreign property, whether it'll come back. I think there's certainly within China, there's certainly political will to try and prevent any help to Australia at all. So if they can prevent money coming in from China to Australia, they will. I think Australia's turning a blind eye to foreign investment that shouldn't be. Like we had when Joe Hockey was Prime Minister, there was there's a lot of discussion about foreign investment and what they're going to do to crack down on it, and all these new rules put in place. But then as soon as Turnbull came in, that all went out the door, and and Morrison as well has paid no attention to it. So I think the government's very happy to turn a blind eye to foreign investors and let them skirt the rules. But it's whether foreign investors have the willingness, I guess, to buy Australian property in this, and that part I really don't know.
Well, certainly the data that I've looked at looks as though it's relatively weak, although, of course, there's a bit of speculation that there could be still money laundering going on. There's, the property sector has been renowned for money laundering here in Australia, and of course, the government never followed up on the recommendations from various international bodies to make sure there's stronger identity checks when people are actually buying and transferring property and transferring funds. I personally think that's a deliberate strategy as well.
Yeah, I mean, that was on that graph of the things that's driving the property prices. That's one of the ones we've got on there is money laundering, because that's
Yes.
I think if we're not number one on the list, we're pretty close to number one on the list internationally for great place. If you're trying to get rid of, if you've done something wrong in China or another country around the world, and you want to try and hide it somewhere, the Australian property market is fantastic for doing so.
Yeah,
so
and Canada's there too. Martin was saying exactly that as well. That Canada's got another big issue there as well. So, it's all very complicated, isn't it?
Yeah. Whereas I can't. If somebody says to me, "I'd like to invest $1 with you," then I've got to send through all these AML checks, and I've got to check against the list and all these things like that. Yeah. And you're like, here can somebody turn up with a sack of cash and buy a property and no questions asked.
Yeah, one rule for them and one rule for everybody else. Here's an interesting question. It says, great discussion so far. Good. Damien, what's your 10-year forecast for yields of Aussie bonds and Aussie equities moving forward? A long-term view.
Yeah. Well, look, I think the Aussie bonds, they're eventually going to go up. But I think they're going down first. So a 10-year bond at the moment is 0.9%, I think, if I didn't check today, but it's in that ballpark. And so that's not a very good return over a 10-year period. But if the bond yields go down first, then we actually think you can pick up some money on some of these. So it's that part where, because all these assets are so finely priced, we're being quite. We think you're going to need to be proactive in terms of moving your money around over the next few years. So yeah, if you locked your money in and you just stuck it in today and then forgot about it, you're getting less than 1% in 10-year bonds. On shares, it's probably a similar number, maybe a little bit higher, but not much. I think there's going to be much better opportunities though. So the types of, I guess one thing is the types of annual returns you're looking at are going to be right now, given where the way markets are prices are so low that just trading in and out and saying, well, if it falls 5-10%, then I buy in, and then it rises 10-15%, then I sell out, is going to make you way more than sort of sitting there and saying, I'm just going to buy it and forget about it. I think there's, and I don't think there's going to be the same companies. I think we are going through some very large structural changes in terms of which companies are making money and which ones aren't. And I think that's, so I think a set and forget investment for today is not really where you want to be. In terms of the way we look at, we tend to do 7-year forecasts, and on our numbers, we can see making a bit of money in bonds over the next couple of years, but then sort of giving it back over, if you just held on, giving it back over. So you've got 2 or 3 years of making money, and then some money, then a few years of giving it back. Equities, we suspect, is more likely for a downturn first before making it back. Having said that, once we clear all this, we can see a number of quite positive things coming through, not quite positive technological changes. So we're actually relatively positive over a 10-year period about where assets are going. We just think the next 3 or 4 years look pretty bad, and you're going to want to be quite conservative for the next 3 or 4 years.
Yeah, so it's interesting. Bumpy ride, but perhaps pulling through. And as you say, there will be opportunities later. But what about wages growth? I mean, that's the other factor, isn't it, right? We've had no real wages growth since 2012, if you look at the statistics, right? And even the Reserve Bank is saying wages growth is going to be lower ahead rather than where it was previously. I mean, that seems to me the other critical factor in all of this.
Absolutely, and the RBA itself got its, it was doing some sort of negotiating with its own staff and screwing them down on wages at the same time as telling everyone else they need to raise wages. Look, it's endemic. Like it's a if it's we've brought in so many people from overseas, under the guise of skills shortages. A lot of them is really because we want to pay lower wages. it's very easy to find people out there who want to get a visa within Australia and might have some IT skills, and so then what it is to have to pay more to get somebody locally. So what that means is we've set up this whole system to try and keep wages low. The great thing about being able to work from home and all this telecommuting and things like that's gone on is a positive in many ways for businesses, but it's also just as big a negative for wages, because it means now that if I'm talking to somebody in the next suburb over, and we're hiring them and doing everything over Zoom calls and things like that anyway. Well, what difference does it make if that person's in the Philippines or in India and a third or a quarter of the cost? And so, not every company will do it, but it will mean that it just keeps a lid on wages within Australia. So, I think there's some big structural problems. I think there's we're going to see. One of the big technological changes I was talking about over the next 10 years is this whole idea of automation and things like driverless cars and things like that, just taking away jobs from lower paid employees. If the governments aren't actively trying to help people switch jobs, then that's going to keep wages low in a whole bunch of industries, and you're going to be left with this sort of two-tiered system of you've either made it enough that you're valuable enough that you get paid quite a lot, or you don't have the skills and you're at minimum wage. And so that's it's a big issue. And I don't think the government's obviously not keen to raise some of the minimum wages and things like that. So until you actually see government starting to come out and go, you know what, we will lift minimum wage by 4% next year, and all our award wages will go up by 4% because we want people to have more money to be able to afford the mortgages, to be able to get the economy going again. Whereas at the moment it seems to be saying, well, no, I want to keep your wages lower, but I'll give you more debt if you like. So until that flips around, I think we're stuck in a low wage growth environment.
Okay, well, we're coming to the end of our show tonight, but one last question briefly. Of all the indicators and indices that are out there, what do you think is the best one to sort of keep a leading eye on in terms of an early indicator of what's going to happen over the next sort of 9 to 12 months?
In which area? Sorry.
Well, I'm thinking, you're making investment decisions all the time. You're trying to work out what the asset allocation should be, and all of those things. Is there one indicator that is it the volatility index, for example, or is it the S&P 500, or is it something else, or is there none? I mean, do you look at multiple things? That's what I'm trying to get together.
Yeah, sure. Okay, so we look at a lot of things. Prices we tend to look at as not as information in their own right, but as a warning to have a closer look at something. So we tend to look a lot at return over medium period times. We look a lot at returns on reinvested capital. So how much money are companies keeping? How much extra debt are they taking? What types of returns are they getting on those? So we spend a long time looking at analyst forecasts and what we're looking at in terms of growth for companies. Having said that, right now, analyst forecasts are terrible. Like companies don't know what they're going to earn. So analysts don't know. And sometimes they get caught in this loop where, like we've seen companies we follow that have upgraded their earnings because strategists at the brokers that are following them have come out with bullish agreements. And so therefore the companies have upgraded their earnings, and then the strategists have come back and upgraded their earnings again on the back of the companies. And you're stuck, like you're just basically saying, you guys are telling them and they're telling you, and you're telling, and everyone's saying how positive it is. And then the company's going out.
Because the dance goes on.
Exactly. And then going, well, we didn't make those numbers. So trying to get to that earnings forecasts is what we think is the key part. But right now, those forecasts are terrible. And so we're going for everything we can. So we look at your data, which we think is great in terms of giving us a nice fast read on what's going on. There's plenty of other sources on those, but the problem with all these other sources is you never really know. Like let's say CBA comes out and says, "Hey, we think the economy is going great because all our credit card data is going ballistic," and you're like, "Yeah, well, what's it doing relative to the cash transactions?" And they go, "I don't know." And you're like, well, we know everyone's paying by credit card now because nobody wants to pay by cash and everyone's tapping. So we've got no basis of it. So there's those types of things where there's lots of those mini bits of data, but we just don't trust any one of them individually. And so it's a matter of trying to grab as many of those as we can and put them all together and then come up with the answer. But yeah, I wish I had a better answer for you. But
no. I mean, but you've made the point which I wanted you to make, which was that there's a set of complexities here in terms of trying to decode what's going on. The data is partial. A lot of the data is myopically produced by organisations who have agendas, if I can put it like that.
Absolutely.
Right? True for real estate data, true for a lot of the transaction data from the banks, true for the home loan data as well. I mean, it is very hard to navigate. And of course, even the official indices, the ABS employment statistics and all those things, I mean, CPI, all of those are myopically skewed as well. So it's quite hard.
Our own treasurer comes out and says, here's the official unemployment numbers, here's the numbers I'm using.
Yeah,
and you're like,
correct. Yeah.
Shouldn't the official ones be the same? Yeah.
Exactly right. So I think it highlights the complexity. Damien, I really want to thank you for tonight's conversation. I found it really interesting, and I've learned a lot. I see the stream has been very positive too. So thank you for your time. And I'll put the links below to Nucleus Wealth. I do recommend that calculator. I do recommend your research. We do feature your research from time to time on our other channels as well, because I think you've got a really good finger on the pulse. So thank you for your time tonight.
Thanks for having me.
Always good. Come again sometime soon, because these things are moving very quickly. So you're welcome to work anytime. And I'm just now going to go across to the main camera and just acknowledge a few people on the stream here. Adida, Nifi, Nico, Savannah, and Jeff. Thank you for your contributions tonight. Just to say that I interviewed George Gammon this morning. In fact, I made two shows, one for this channel and one for his channel. My show with George will be up tomorrow. We spoke about the Fed, and basically the Fed and the Future is the title, so that's worth watching. George was on fire, so watch out for that. And I will just finally say that next week, on the 6th of October, I will be running a live stream. Now, that's budget night, and I don't promise to be able to have up-to-date budget information at 8 p.m. when the budget starts at 7:30 p.m, but I'll have a go. But I'm also going to talk about the September scenarios and also our mortgage stress data, so that should be a show worthwhile. And I think that we will have a really interesting debate there, and also, as I say, some of the budget stuff as it comes out. So I want to say thank you to everybody tonight for spending time with me and with Damien. Damien, once again, thank you very much for your time. Really appreciate it. And great work. I do love those models. I love your property calculator. I keep recommending it to everybody, so I hope you get a lot of hits on it.
Much appreciated, man. Yes.
Okay, right. Thank you, everyone. I'm going to end it here. So good night, one and all. The NBN held up. Yay. So we got there. That's really good news. And we'll see you next time. Martin North from Digital Finance Analytics, signing off.